While other major economies are raising rates to fight inflation, China cuts its key interest rate again in August, the second time in 3 months. China has been easing its monetary policy to help its economy to bounce back from the pandemic, but the macroeconomic data continues to deteriorate. The CSI index, the best representative index for the China market, has been flat since China reopening. We are going to look into it today. Today's topic is probably more relevant to you than you thought. Even if you are not investing in China and Hong Kong market, or even if you are not investing in stock market at all, you will still be affected by Chinese economy. How so? China economy was meant to drive 1/3 of the global growth this year. So a dramatic slowdown in China economy, it would mean a slowdown across the world. That would include Malaysia, of course, as China is our largest trading partner for 14 years consecutively. To a very large extent, the weakness in Chinese economy has contributed to the weakening of ringgit Malaysia. That alone is very serious. And if you are actively investing in China's and Hong Kong market, you would notice that the valuation for China's market is relatively low. You may have also noticed that many individual companies are performing quite well, albeit their share price are being kept by the weak macroeconomic data. So could this be an opportunity, or is it just a storm that has yet to come? Hi everyone, I'm Mr. Te from the Modern Reminder. Welcome to the Market Highlight series. In this series, I would update the interesting event that happened recently and see how we can position our portfolio according to this event. In theory, and usually in practice, the easing monetary policy goes together with the stock market. This can be seen during the pandemic when most of the economies reduced their interest rate, reduced their reserve requirement, and for some major economies that did not have much room to reduce in the first place, they have opted for other channels like quantitative easing, economic relief, personal and business assistance, etc. These kind of stimulating measures, they stimulate the economies, they encourage borrowing, encourage spending, therefore flush the economy with a lot of liquidity. Often this liquidity flow into the stock market, therefore pushing up the stock prices. This sort of stimulating measures sometimes come with a price. When there's too much liquidity in the system with limited supply, it can lead to inflation. This is exactly what we are witnessing right now in US, UK, the EU, but not in China. Why not? Because China had not done as much in monetary easing during the pandemic compared to these economies. One of the reasons is that China did not fully reopen its economy only until early 2023. By that time, most of these major economies had already gone through this crazy stimulation, pushing up asset prices, inflation hit. They have to raise their interest rate to fight inflation. Now imagine putting yourself back to early 2023, when most of the major economies were thinking how to restrain their monetary policy to fight inflation. China had only just opened its economy with so much policy option in hand. So it makes perfect sense to invest in China then, or maybe even now. But why 6 months after the reopening, China's economy still fails to make a comeback? Liquidity trap is a situation where monetary policy becomes ineffective because even a lower interest rate cannot stimulate economic activity. This is because people has become so pessimistic about the future that they are unwilling to borrow and to spend even at a very low rate. While balance sheet recession is a kind of recession when high-level private debt cause individuals and companies to collectively focus on saving to pay down the debts rather than borrowing and spending, causing economic growth to decline. This is usually intensified by an aging and shrinking population, like the Japan in 1990s. The two biggest fears for central banks are first, not being able to contain the inflation by raising the interest rate, and second, not being able to stimulate the economy by reducing the interest rate. Ironically, the former is now faced by most of the major economies and the latter is now faced by China. There are concerns that China may now be facing a liquidity trap or balance sheet recession, especially when China's population chart starting to look like Japan's. There are 3 reasons why I think it's too soon to jump into that conclusion. First, the obvious one, the nominal interest rate in China is not low enough to support the notion that China has fallen into the liquidity trap. The real interest rate, which has taken the inflation into account, has stayed firm. Second, unlike Japan, even with aging population, China is still considered a developing economy. So there is still significant scope for private consumption to grow with expanding middle class population. Third, we mentioned that balance sheet recession happens when there is high level private debt, cause individuals and companies to collectively reduce borrowings. While China has a high debt to GDP ratio, but when you look at the household debt to GDP ratio, it is quite low at 60%, while the corporate debt to GDP ratio is very high at 160%. Analysts estimate that 2/3 of this debt is in the hand of state-owned enterprise. In other words, the reluctance to borrow more is initiated by the government, not so much a consensus among the household and private sector companies. Still, China has its problem. Consumer confidence stay at near record low while household savings surge. This is telling us that the households are reluctant to spend, to invest, even though they have the money to do so. The low level of confidence is partly caused by the geopolitical tension, the US-China trade war, the uncertainty in demand. We all know about that, but it was mainly triggered by this 3 red lines policy unveiled by Chinese government on the real estate developers in August 2020. I don't go into the details of the policy, but it was meant to reduce the high corporate debt, to reduce the speculation in real estate, and to shift away to debt-fueled growth to quality, growth, and technology. To China's credit, parts of the economy like the EV, the wind and solar power, the battery are booming. Investment and exports in this sector are growing at double-digit rates, exactly the kind of quality growth that they are aiming for. However, you don't see this kind of growth in macroeconomic data because this growth is not meaningful enough to offset the slump in property sector. We need to remember that the property sector and its related sectors contribute to about 20% of China's GDP. Big shoes to fill it. Also, it is one of the main investment avenue for Chinese households, making up 70% of the household wealth, compared to just 20% in stock market. Therefore, even though the experts are saying that the China's property crisis is not comparable to the US subprime crisis, but the impact is expected to be big. Imagine 70% of the household wealth, and they have been investing in real estate for more than 3 decades. You can't expect them to just cut loss and then shift it to other investment like the stock market. Of course, they are going to keep holding the cash first, and of course the consumer confidence is going to stay low. And these sort of negative sentiments are often self-fulfilling, causing a downward spiral. It is too soon to conclude that if liquidity trap and balance sheet recession are now happening in China. Many problems we are now seeing in the China's economy stem from the government's conscious decision to sacrifice for a better future. Call it short-term pain, long-term gain if you want. It certainly took courage to do it. Maybe it is only possible for a single-party authoritarian political system like in China, because a more democratic political system would have gone for a more pleasing policy to gain votes. We expect more stimulating measures to come to boost consumer confidence. The government is capable of doing so because they still have a few policy options at hand. At the same time, the government is unlikely to unleash massive stimulating measures because that would contradict the purpose of deleveraging. Going forward, China's economy is expected to progress 2 steps forward, 1 step back, because the government has to balance between stimulating the economy and also limiting the corporate debt until the new economy is able to take over the loss in real estate sector. That is also a big if. If you are investing in China/Hong Kong index or index-based unit trust, you won't be able to see any meaningful rebound in any time soon. You may still be able to profit through the range-bound trading if your entry and exit fee is very low or zero. If you want more information, you can contact me for that. Given the fact that the government still have few policy options at hand, the general market is unlikely to collapse. There are still many other investment opportunities in specific sector, especially those the government is in supportive of. Those can yield you superb returns. That's all for Market Highlight of August 2023. If you want a more frequent and timelier update, you can contact me through the link to the Google form below, and my team will get in touch with you. If you like this video, do the usual, like, share, subscribe. Until next time.